Okay, very well. Welcome back to another session, which will be talking about debts again. And so this is um, the fifth class, okay, in our recordings, and we're still talking about debts. Um, okay, so we just want to talk about the last segment of the last segment of debt, uh, which which is convertible debt. Now, convertible debt, convertible debt. Okay, so we speak to when we say convertible debt, um, we speak to convertible debenture, convertible bond, convertible loan stock, and so on, right? So and it's we say it has elements of equity in it. So how does this work? If you are an investor and you subscribe to a convertible bond, what it means is that you are free to convert your bond into equity. Okay, so I'm really going to show this almost the same thing we discussed about debt is still applicable here. It's just that we are taking it a bit step further because of the equity element that is inside. So there is something, um, a terminology we called conversion value. So a conversion value, it is equal to PO 1 plus G, okay, raised to power N times R. That's conversion value. So conversion values, it's that is equivalent to redemption value in the case of a normal bond or debenture or any other debt. That's a redemption value. So now it's the value on the last day where you are converting the debt to equity. Okay, so this formula I give, sometimes the examiner give the conversion value. They don't give the formula, sorry. Sometimes they give the conversion value, the figure, sometimes they don't. So in the case where they don't, we have to calculate it. Okay, so here, what we have here is, so what we have here, PO, what is PO? Where PO is current share price, the current share price of the company in the market. G is growth. G represents growth rate in share price. G represents growth rate in share price. N N represents N represents number of years conversion 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 option to expire, so or lapse, the number of years it will take for the conversion option to expire or lapse. That is, and sometimes we'll say, oh, convertible bond, 5 years, but option to convert will lapse in 2 years or 3 years. What it means is that within the first 2 or 3 years of the convertible bond, if you don't convert, if it is 3 years, if you don't convert in the first 3 years and the option lapse, you can't convert to equity again. So you can only convert in between, before, within that option, when the option is still available. Or do you understand? So that is how it works. So that will be our end. The big R represents conversion ratio. The big R represents conversion ratio. Okay, what it means is that, okay, for every 1,000 bond, how many shares you are going to are you going to get? Oh, for every 1,000 bonds, you are going to get 40 shares. You are going to get 90 shares. You are going to get 300 shares. You are going to get 50 shares. That is the conversion ratio. So if it is, oh, every 1,000 bonds, you're going to get 35 shares, our R will be 35. Okay, so basically this is one of the a bit one of the bit step further we are going to add to our debt. So like I was saying the other time, is equivalent to conversion value is equivalent to redemption value. Okay, conversion value is equivalent to redemption value, right? Redemption value. So what we are saying here is that is either you use conversion value or you use redemption value. Okay, so anyone, this is applicable when we are facing convertible debt. So the ideal thing is going to be the higher, use the higher, use the higher of the two. Okay, use the higher figure or number. So use the higher of redemption value or conversion value. If conversion value is higher, use that. If redemption value is higher, use that. Okay. Okay. So now, very quickly, we have, okay. Now, this is like I said, that's just about that. And if you are using conversion value, you know that you are going to use the number of years which conversion will lapse. So, for example, if your if the debt you are looking at is like 8 years maturity, conversion lapse in 3 years. So when you are using conversion value, the number of years that you consider as maturity is 3 years. But when you are using redemption value, the number of years you are considering will be 8 years, because 8 years is when redemption will be made. But 3 years, year three is the last day for conversion. If you don't convert in year three, you can't convert anymore. So, all right. So that is why you are going to be based on year three. But we have some exam questions such that, oh, maturity is 8 years. Conversion will lapse in 8 years. That is, if on the day of redemption, if you choose not to redeem, not to collect your money back, you can convert on that day. You can wait till maturity day before you convert. You can show. So that is how this normally work. Okay, now let us please quickly look at a question to really explain this, which is ICAN question. Please look at November 2016, question 2. I repeat, November 2016, question 2. November 2016, question 2. Okay, this is a question. I believe you can see it on the screen. Okay, that is November, as you can see. Yeah, November 2016, question 2. So I read. Okay, a short story. Honeycomb PLC has issued 10% convertible stock, which is due for redemption in 10 years' time, December 31, 2025. The option to convert open only for another 2 years. If conversion does not take place by 31st December 31st, 2017, the option will lapse. So that is option to convert is 2 years, and this bond is for 10 years. The issue was sold to the public at a price of 920 naira for 1,000 of convertible loan stock. The conversion rate at January 1, 2016 was 250 equity shares for 1,000 stocks. So that is our big R conversion ratio. The price at which the loan stock was sold was 920. So what it means is that you as an investor subscribing to the loan stock, you bought it at 920. You bought every 1,000 at 920. Okay, let's continue. The conversion rate at, okay, I've read that part, 250. Okay, non-convertible loan stock in a similar risk class is presently yielding 12%. Now, this is another security which is non-convertible. So we just read about convertible. This one is non-convertible. Okay, the market price of Honeycomb PLC equity shares has been increasing steadily over time, reflecting, okay, reflecting the performance of the company. The shares currently pay a dividend of 30 kobo per share. The current price of the convertible security is 960. Now, that is the current market price of the convertible security is 960. Now, and each share is currently valued at 3 naira. That is the current price of the share. Holder of the convertible loan stock is considering whether to sell his holding or continue to hold the stock. Ignore taxation while answering the question. Now, you see, they are saying is considering to sell. If consider yourself as the holder of this security, you bought it at 920. Now, the value is now 960. It's now not a good thing, all right? That means you have made a gain of 40 naira. So you can choose to, if you say you want to sell it, you actually have a case, okay? You actually have a case to sell it, okay? But let us see the requirement examiner is asking us. Okay, now, A, what is the value of the security as simple unconvertible loan stock? What is the value of the security as simple unconvertible loan stock? All right. Okay, let us quickly let's quickly go for it. Now we have um okay okay okay, so let's quickly go for it. Now we have what we call market value. So they're asking us to calculate the market value of the loan stock as a simple unconvertible. They are not asking us to calculate the market value of convertible loan stock. They are asking us to calculate the market value of unconvertible or non-convertible loan stock. So this is still the normal market value that we are familiar with. Okay, what do we need to calculate our market value of debt? We need coupon. Okay, now what is the coupon of this unconvertible loan stock? If you look at the story, we don't have coupon for unconvertible loan stock. What we have for unconvertible loan stock is 12%, which is the yield. Okay, but we can use the coupon of convertible loan stock for it. Why? Because because they said non-convertible loan stock in a similar risk class. What they are trying to say there is that non-convertible loan stock and convertible loan stock, they are in a similar risk class. The implication of that is that anything that belongs to convertible loan stock, you can use it for non-convertible loan stock. Anything that belongs to non-convertible loan stock, you can use it for convertible loan stock. Please, I want you to watch this phrase very well, or this statement. Examiner use it sometimes. Okay, they will say this and this and this, they are in similar risk class. They use it for companies as well. Okay, if they say company XYZ and company ABC, they are in a similar risk class. If you want to do something for company ABC, it means you can use the details of some details of company XYZ for it. If you want to do something for company XYZ, you can use some details from company ABC for it. That is what examiner normally do sometimes when they say, oh, that's why they always say in similar risk class. So we can do something like that. Use this one for this one for that one, because they are in a similar risk class. Okay, very well. Now, now let us go to look at how we can solve this question. Calculate. We are just going to calculate it. Our coupon is going to be 10%, because 10% is for convertible loan stock. But convertible loan stock and non-convertible loan stock, they are in a similar risk class. Non-convertible loan stock has 12% yield. That is a cost of capital. The redemption is the maturity is 10 years, and then redemption value is going to be 1,000. We are going to assume that redemption value is going to be 1,000. Okay, so I think we have all the details we need to calculate the market price of this bond. So let us go on. All right, very quickly. Okay. 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 So now Honeycomb. Okay. Honeycomb PLC. Calculation of the market value of market value of a simple unconvertible loan stock. Okay. Okay. Now, so what we have is going to be coupon. Coupon is 10%, which is 10 divided by 100 times 1,000 naira equal to 100 naira. Redemption value is equal to 1,000 naira. Maturity is 10 years. Maturity is 10 years. then yield is 12%. Okay, yield is 12%. Now, let's calculate. Okay, so we have year. We have year 1 to 10. Then we have year 10. We have our cash flows in Naira. Every year, 100 Naira. In year 10, 1,000 Naira will be the redemption value. Discount factor is 12%. That is, that is 12%. Now, so that's our cost of capital. Then we do our PV. Now, I'm going to do this. What is annuity factor? Okay, annuity factor of 12% for 10 years. Okay, check the table. Check the table. What do we have? If you go to the question, you go to if you go to the question, you go to the question, you go to the table in the question. Okay, if you go to the table in the table page inside the question, you are going to have you are going to see the table, which is after the formula page. Look at 12%, trace it for 10 years. What do you have? On my table here, I have 5.65, 5.65, 5.65. Zero. Okay, that is the annuity factor. Then we have 5.650. Now we have okay 1.12 raised to power minus 12. That raised to power minus 10. That is the present value factor. We have 0.319, or let's say 0.322, 0.322. Okay, 0.322 times 1,000, that is 322. That's our PV. 5.650 times 100. We have 565. What is the total? 565 plus 322. We have 887. This is the price of unconvertible loan stock. This is the price of unconvertible loan stock. Okay, very well. Yeah. Okay. 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 So we have done the calculation. Okay. Now, if you go back, um, Now, if you go back to the question B, we just did question A. What did question B say? Question B is talking about, let's understand question B, 2B. Okay, quickly go there. Question 2B says, okay, question 2B says, what is the expected minimum annual rate of growth in the equity share price that is required to justify the holder of the convertible loan stock holding on to the security before the option expires. Holding on to the security before the option expires. Okay, now, the minimum growth rate in share price, okay, that is required to justify the holder, of convertible loan stock holding onto the security. Now, so they are saying that what is the minimum growth rate? Because they said their share price, which is 3 naira, is growing steadily. So what is the minimum growth rate in share price that will make the investor to continue to hold the security before option expires? So that means it's going to convert, okay, when the option is about to expire. So now, what is the down? You remember that in conversion value, there was a formula in conversion value, okay? Your conversion value, let me write the formula again, which is here. Say conversion value. Okay, I said P0, that is current share price, 1 plus growth rate, the growth rate in G, raised to power N times R. Raised to power N times R. So that is the formula for the conversion value. Now, examiner is trying to say this G, what do we call it? Minimum growth rate in share price. So that is the G they are asking us, the growth rate they are asking us to calculate. So we would find it in the formula for in the conversion value. But the thing here is this: examiner did not give us conversion value. We don't have conversion value. If we have conversion value, we would have easily solved for G. We have the share price. I've seen share price. We have number of years for the conversion to lapse. We have that is N. We have conversion ratio, that's 250. But we do not have conversion value. If we had gotten conversion value, it would have been very easy to calculate this G. But we have something. We have 960, the current price of the convertible security, which is 960. So that can be used, all right? Now, in here, we say the current price of convertible, the market value of convertible loan, all right, stock is what? 960 naira per 1,000. So that is the price. Now, the one we calculated the other time, what was it? This one, 887, that is for unconvertible. Now, look at the way we calculated this one, okay? That is how they calculated that 960. Now, that is for convertible, okay? Now, in calculating that 960, okay, this is the formula they used. I'll quickly go to the formula. They said PV. Remember, I said the market value of debt is the present value of the future cash flow discounted using yield or using cost of debt, okay, which is equal to which is equal to A1. A1 is the coupon of year one, which is cash flow in year one, divided by 1 plus R raised to power 1 plus A2 divided by 1 plus R raised to power 2 plus A3 divided by 1 plus R raised 1 plus R, all right, divided by 1 plus R raised to power 3, okay, plus A(n) time 1 plus R raised to power n, and so on, okay, and so on, all right? So we have, okay, and so on. So that 887 we calculated, if we do it this way, we'll still get the same answer. It's just that we'll be doing it A1 to A2 to A3 to A4 to A5 to A10. That's too long. So the shortest cost, the short cost to get it done is to do it the way we did it and get the 883. But because of the way question B is, and because they asked us to calculate G, this is how we should do it to get that G. So let us go on. What is the PV? The PV is the current market price of the convertible bond, which is 960. Remember, the market value of debt is the present value. That's how we've been calculating it. The present value of the future cash flows discounted using the yield. Okay. So, and they have already given us the present value of the convertible security, which is 960. So we'll say 960 it is equal to, what is our A? Our A is coupon. What is the coupon? Coupon is 100 naira. We've calculated it before. Convertible 100 naira in year one divided by 1.12. That is 1 plus R. Our R is 12%. 12% is the yield. Okay. Okay, which belongs to unconvertible, but they said they are in similar risk class. That is why we can use the 12% for convertible as well. Then plus our 100 naira again in year two, because you are still going to collect coupon in year two, divided by 1.12. That is 1 plus R raised to power n raised to power 2, excuse me, plus now everything we end in year two. All right, everything will end in year two because year two is when conversion lapse. So, but instead of using conversion ratio, instead of using redemption value, we are going to use conversion value because that is when conversion will lapse. And we are actually calculating, it's like we are calculating the present value. But we want to calculate this 960, which is the present value of the convertible or the market value of the convertible security. So conversion value is what we are going to use. And we don't have the conversion value, but we have the formula. The conversion value is what? P-O, Abi, 1 plus G raised to power n times R divided by 1.12 raised to power 2. We are going to discount that conversion value as well. That's why I said divided by 1 plus R raised to power 2. Now, our 960 still remains 960 here, which is equal to, now quickly discount this. If I say this 100 divided by 1.12, I get 89.29. I get 89.29. Then I will say 1.12 1.12 raised to power 2 equals to this, and 100 divided by that. 100 divided by answer. I got 79.72 approximately. Then plus, what is our PO? Our PO is 3 naira. That is the current share price. 1 plus G, that is what we are looking for. What is our N? N is 2 raised to power 2, because that is when option will lapse. It will lapse in 2 years. What is our R? Conversion ratio, that is 250. So this conversion value divided by 1.12, we cannot do it like this because there is still an unknown variable in the equation, which is G. But let us quickly solve. Now, this is math now. So let us quickly solve for what we can solve for. All right. 89.29 plus 79.72. It is equal to 169.01. Let's just say it is equal to 169. So collect the like times. This is equal to 169. Then 960 equals to 169 plus, now 3, let the conversion value 3 times, I can't say 3 times 1 plus G, okay, fine. But we can say 3 times 750, 3 times 250. 3 times 250 is equal to 750. Okay, 750 times 1 plus G raised to power 2, all divided by 1.12 raised to power 2. Okay, so quickly go to the next slide. All right, by the time I get to the next slide, I'm going to collect like times. 169 will come to the other side. It will now be 960 minus 169. Then it will be 960 minus 169 equal to 751 plus G raised to power 2 divided by 1.12 raised to power 2. Okay, 960 minus 169 gives me 791 equal to, okay, 791, and I cross multiply straight up like that. So if I cross multiply, it's going to be 791 times 1.12 raised to power 2 equal to 751 plus G raised to power 2. So what can I do here? I can do, okay, 1.12 raised to power 2 equals to this times 791 equals to, I got 992 approximately, equals to, then divide both sides. Divide both sides by 750. Okay, divide both sides by 750. Okay, I am going to have 992 equal to 1 plus G raised to power minus raised to power 2. Then move there. If you now say, it will now be G will be equal to 992